All right, folks, we're taking a look here at test number 9, most missed questions. I'm going to go through I think it's 7 most missed questions, and then at the end I'll I'll talk about the 3 questions that I tossed off the test and didn't score, and I'll briefly go through those as well. All right, so there was a major theme of missed questions on this test dealing with inflation, but in particular dealing with winners and losers from inflation. So that's really important that you go back and take a look at the video I recorded a week ago about winners and losers, because that's going to be a really key concept throughout the semester, and we'll hit on it a few times here in this little video. So number 4 is a question like that. So we have an unexpected increase in consumer prices. So we have inflation that people did not anticipate. And this is going to inflict costs or put a burden on all these choices except for one, and the correct answer is borrowers. So the bottom line is this: when we have unexpected inflation, there's always going to be a transfer of wealth from people who are lending to people who are borrowing. Another way of saying that is people who are savers to people who are debtors, people in debt. So anybody in debt will benefit from inflation, increasing inflation higher than thought. Anybody who's on a fixed income, that means their income is the same all the time. When there's inflation, that's going to cause their income, the real value of their income, the purchasing power of their income is going to decrease. So it certainly doesn't make them any better off. In fact, it makes them worse off. Inflation can result in higher nominal wages, the number of dollars you're earning, and that can cause people to have to pay more in income tax, even though their real income hasn't changed. You've got, like, say, a tax bracket at $50,000, and maybe someone's at $48,000. Then due to inflation, their nominal wage rises to, say, $52,000, but maybe their real wage hasn't changed. They're not able to buy anything more because the price of everything went up. But now they find that the last $2,000 they earn, because they're at $52,000, and I said the bracket begins at $50,000, the last $2,000 they earn is now taxed at a higher rate than it was previously, even though it's not like they're actually any better off in real terms, because if their wage goes up at the same rate as inflation, then their real wage hasn't gone up. But yet they're finding themselves in a higher tax bracket. So you look at the list, and everything except for borrowers are all made worse off. Borrowers are made better off when there's unexpected inflation. That's because they're paying back dollars that are worth less than the dollars that they borrowed. Again, that's all explained in more detail in the winners and losers video, so you'll want to watch that. This question here, we're basically saying, look, GDP equals C plus I plus G plus net exports. And if the C plus I plus G portion of that is equal to 103% of GDP, meaning that C plus I plus G adds up to more than GDP, then that means net exports must be negative. And I have an example right here that you can look at and work yourself through where I used make-believe numbers, but that all works out to where C plus I plus G adds up to $103, and if GDP is $100, then CIG is worth 103% of GDP, and therefore X minus N, or net exports, that should be X minus M, my bad, X minus M, must be -3, so that C plus I plus G plus net exports equals $100. So that's how that question works out. Number 10. An increase in the number of discouraged workers will cause unemployment rate to do something and the labor force participation rate to do something. And so I've created a little imaginary scenario here. On the left-hand side, we have 100 people. 40 of them are employed, 10 of them are unemployed. Nobody's discouraged. So then you can go ahead and calculate the labor force participation rate and the unemployment rate from that. Then the question is saying, if the number of discouraged workers, if there's an increase in that, well, to become a discouraged worker, you have to have been unemployed and then stopped looking. You gave up looking. So that means the number of unemployed people has to go down. So 10 drops to 5 because 5 of those 10 people are like, there's no jobs, I'm not looking anymore. So now they become discouraged. So unemployed is only 5, while discouraged goes up to 5. So you can see how those numbers changed. And that changes our calculations here in a predictable fashion, where the LFPR goes down and the unemployment rate also goes down. And so those examples hopefully help you see that a little bit better. Number 22. So the CPI, what is it designed to do? Well, it simply measures the cost of a market basket of goods and services. A lot of the other answers were appealing, but there's some explanations here for why they weren't right. It doesn't measure the price of goods produced in an economy. It only measures the price of a select basket of goods and services that is meant to represent something. So the CPI is meant to represent what a typical consumer might purchase, but it doesn't represent what is produced. Some of our production ends up being purchased by foreigners in the form of exports. Some of our production ends up being purchased by the government or purchased by businesses. So consumers don't purchase all of our production. That's what the GDP deflator actually shows us, is the price of our produced goods over time. It doesn't measure changes in the spending patterns, because the whole point of the market basket is to hold fixed what we're keeping track of. So that doesn't change. It measures both goods and services, not just manufactured goods, although manufactured goods are part of the market basket. And it measures the cost over time of a market basket that represents the average consumption of consumers, not the spending patterns of all consumers. And that sounds kind of ticky-tacky, but it's an important point. We're not actually measuring the pattern of all consumers. There's consumers out there that may not buy certain things. For example, I don't pay for television. I don't have any sort of subscription service for TV, but the average consumer does, because some people have it. So the CPI does not represent my personal consumption pattern, and it probably doesn't represent any actual person's consumption pattern. It represents the average consumption pattern, or you might say the typical or median. Maybe it's median. It's more average, I suspect, than it is median. But it represents a typical person, not every person. Number 30, this was the most missed question. Only 32% of people got it correct. And it's a tough question. I mean, it really is. So it's worth looking at here. We have this equation: GDP deflator over 100 equals nominal GDP over real GDP. So that is the equation that you know, but changed a little bit, right? You know that nominal over real times 100 equals the deflator. And this is just restating that by taking the times 100 and dividing both sides by 100. So that is a restatement of that equation. Okay, so with that in mind, if the if the average price level increases by 10%, what that means is that this side of the equation is going up by 10%. So we're going to have this side go up by 10% to keep the equality. But the question goes on to say real output remains constant. Well, real output is real GDP. So if this goes up by 10%, and if we don't allow this to change, then the only way this side can go up 10% is if nominal GDP goes up 10%. But nominal GDP is not one of your choices, but nominal national income is, and we can hopefully understand that GDP at the macro level is equal to the national income. And so the nominal national income is another way of stating the nominal GDP. Number 43. These next two are similar to the first question I went through, where we're talking about unanticipated inflation. So a lender, somebody who lends money, or you could also potentially say a saver, somebody who's saving their money. If you save your money, you may be willing to lend it out. So a lender will realize unexpected benefit. So a lender wins, you might say. They might become better off. They benefit when they make a loan, and then when it comes time to pay back the loan, inflation was not as much as was predicted. Because when you make a loan, you tend to, or you will, charge interest. And the interest you charge is going to include some assumption about inflation. The higher you assume inflation is going to be, the higher the interest rate you're going to charge. And it turns out if inflation isn't as high as you thought it was going to be, then you sort of got away with charging a higher interest rate than maybe you should have, and you end up then collecting more interest. Your real interest rate is higher than was thought. So this equation is extremely important. Again, this is in the video called Winners and Losers, and is totally worth checking out if you don't really understand this concept, or maybe you didn't watch it in the first place, in which case you really ought to go back and check it out again, because this is not just some side topic, but understanding real versus nominal is pretty critical for macroeconomics. This question is really similar, just using actual numbers. And so again, real interest rates equals nominal interest rates minus the rate of inflation. These are all percentages. So you can plug in 2 and calculate the third. And so the question is basically saying that, look, if there's an oil crisis in the Middle East, you don't really understand why this would do that, but whatever. If the inflation rate goes up to 4% and the real interest rate does not change, it's still 7%, then we've got 7 equals x minus 4. So x has to be 11. All right, so let's take a look briefly at these are the questions that were sort of omitted from the test. Everybody got credit, but just wanted to point something out. All right, so on this one here, and yours might, all these years might be in a different order. It depends on which version of the test you had. But the problem with this question, the reason I had to get rid of it was, which of the following individuals is considered officially unemployed? So Chris, who has not worked for more than 3 years and has not given up looking for work, would be unemployed because he has not given up looking for work. But Pat up here, who recently left a job to look for a different job in another town, he's also unemployed. Pat is frictionally unemployed. So really both these choices, the Pat choice and the Chris choice, are correct. And so I ended up I was either going to get rid of it or I was going to give everyone credit, so I decided to give everybody credit as a way of sort of curbing. All right, number 12. All right, the CPI does not measure the true cost of inflation. Okay, so the CPI measures inflation. The idea of the CPI, again, is that you have a fixed market basket of goods and services. We track that basket over time. That basket is supposed to represent what the average consumer purchases. Well, it turns out that within that market basket, you have certain goods and certain services. And if individual goods or services in that basket start to go up in price, you as a consumer might try to find a substitute for that particular good and service that is less expensive. So while that basket is going up in price maybe 5% a year, because you're grabbing the items that are becoming more expensive and sort of tossing them from the basket and replacing them with something that's less expensive, the actual rate of inflation that you're feeling may be a little bit less than, say, 5%. Okay? So the Consumer Price Index does not measure the true cost of inflation. And so we look at the choices here. Changes in consumers' real income are not accounted for. No, that doesn't really matter here in what I'm explaining. Borrowers are better off. This has nothing to do with borrowers. Improvements in the quality of goods and services are not fully reflected. That's something we're going to come back to here in a second. And then lenders are better off when the actual inflation is less than anticipated inflation. So that is true, but that has nothing to do with the CPI and how it doesn't measure the true cost of inflation. And then consumers may substitute towards more expensive goods without being significantly worse off. Well, consumers will substitute towards less expensive goods. So that's not right. So these here don't apply. And that leaves us with this one. And I wanted to mention the idea of consumers substituting because I wanted you to understand this concept, because that whole substitution issue may come up again in your future. But here's another problem with the CPI. Since that market basket doesn't change over time, then if the quality of those goods improves, so say cell phones have gotten better over time, then even if cell phone prices are going up, say 5% a year, we know the quality of cell phones is going up way faster than that. And so we're not actually accounting for that. So you're paying a little bit more in price, but you're getting a lot more in quality, and the CPI does not account for that. Okay, and the last one here is number 45. This is just a little accounting thing that you need to be familiar with here, but we do count newly constructed homes as part of private investment. Okay, it's just a nugget of knowledge to know. You may not have known that, but new homes are investment, not consumption.
All right. We'll talk to you later. Have a great long weekend. Adios.